and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. For this edition of the podcast, I'm very fortunate to have the chance to speak to Elisabeth Stheeman, who is the chair of Edinburgh Investment Trust, among other directorships and appointments that she holds. It makes a nice refreshing change, if I may say so, Elisabeth, to have not only another chairman of a board on the podcast, but also one who is a woman. We don't have many of those yet. Perhaps we should have more. And also one who comes, I think, from a slightly different background. You don't come purely from an investment trust or investment background. I think you work mainly in business and so on in a number of roles, which we can maybe talk about in a moment. So let's just kick off by asking you, how you came to be involved as a director of an investment trust. What was the route that led you to this particular position you now hold?
Thank you, Jonathan, and also thank you for having me. It's a pleasure. Well, how did I get involved with investment trusts? It's really credit to my predecessor, Esther Glenn Suarez, who got in touch and asked whether in my then role at the Bank of England, I could get involved in investment trust. And I knew obviously about investment trust, hadn't really considered them at that stage as a non-executive opportunity, but was happy when a search firm contacted me to go down the route. And all credit to the whole board of Edinburgh Investment Trust to be open enough to bring somebody in who brings a different perspective. I suspect one of the reasons they were interested to have me on the board was my broader experience, as you mentioned, having been in financial services for some decades, both in executive and in non-executive roles, and then more recently, my roles at the Bank of England, perhaps bringing a sort of more macro view to the role, and also having seen different governance structures, both in the UK and Germany and France, and working in different regions.
And what is your impression of investment trust boards? I mean, when you became a non-executive director, before you became the chair of this particular trust, was there anything about the way that the boards of investment trusts run that surprised you? I mean, there aren't as many board meetings normally, except in interesting times, as there are perhaps in some other companies. What were your expectations, and how did they differ from what you actually found when you started as a non-exec?
Well, perhaps I can start with what an ex-colleague of mine said to me, who I spoke to when I was thinking about investment trusts. It was somebody who was on a few investment trusts, and I asked them what their experience was, and they said, investment trusts, very predictable, 4 board meetings a year, very manageable meeting packs, nothing very much ever happens. So this was back in probably early 2019. After I was approached about the role, and I then joined in May 2019 and have had an incredibly interesting experience. I wouldn't necessarily now describe it as nothing ever happens. We've had, as you know, quite a lot happen at Edinburgh for good reasons. So one of the things that happened early on, and we can perhaps talk about that a bit more later, is the change in manager. So very soon after I joined the board, we started a process reviewing the manager with the help of external advisors. So I would probably call it a very steep learning curve in a good way. And there were lots and lots of board meetings. I haven't even met all the stakeholders, but then obviously I'd met my fellow board directors, but really only in the interview. So this sort of even started before my first in-person board meetings. And thank goodness this mostly happened second half of 2019. So everything was in person, although quite a lot on conference calls, audio conference calls, which is now hard to imagine. So when you have sort of 10, 12 people sometimes on the call, including advisors, it was sort of quite tricky to know who was who. The good news is, thanks to my fabulous colleagues who also were very good at helping me along, I got up the learning curve quickly and learned a lot in the process. So it's definitely not been boring in any way. It's been a fascinating journey and with a very good outcome overall.
Since your appointment, indeed, I mean, the context, I think, when you joined the board back in 2019 was The Edinburgh Investment Trust had been managed for many years by Mark Barnett, who was at Invesco Perpetual, and had a strong following for many years. But then his particular style of investing, which was, I suppose you'd call it as towards deep value anyway, but certainly the value investment style, and his performance began to deteriorate significantly. And then you ran into COVID as well, when the whole market sold off as well. So I suppose when you joined, did you have any idea that you would be actually changing manager within 12 months? And what was the moment at which that was sort of triggered? Because there's been a lot of talk about the relatively poor performance of Mark Barnett's funds for a period. What was the process and what was your thinking as you went into that decision?
Well, obviously the board couldn't really tell me anything about any process during the recruitment process. So at that point, I had no idea and couldn't really have an idea about what might lie ahead. To be fair, the then chair of the investment trust had coffee with me as soon as I was appointed and said, okay, let me now give you a bit of a briefing and background, what's going on here. And that helped me enormously to understand where the board was. At that point, as I mentioned earlier, they just started a process reviewing the manager, and that took some months, mostly sort of back end, second half of 2019. So to answer your question, I would say it was a mix of different reasons. Mostly really, as you mentioned, the challenging performance under the previous management. It was very much based on dividend income. That, to be fair, had been good, but capital growth was disappointing. And the end result was total returns were poor compared with the UK index. And then as a board, we consulted the shareholder base extensively and decided that it would be in the best interest of shareholders if we reviewed the management arrangements. As this is sort of usual in these instances, a formal review process was conducted with input from Investec, our brokers, and an investment consultant, Willis Towers Watson. And then we had a short list of 5 managers, including Invesco, the incumbent. And Majidi, as a team, presented a very convincing case for their investment process to underpin a total return, especially an attractive total return. It naturally has been very pleasing to see that exactly this investment process has delivered a very positive performance outcome in the 4.5 years since the change of manager. The other thing Majidi set out very clearly in their proposal at the time was the promotion of the trust to both existing and potential shareholders. And again, this aspect of their role has developed nicely. And then finally, Majidi, as you know, became part of Lion Trust in early 2022, and there's been an increase in investment marketing and promotion of Edinburgh ever since, especially given the higher proportion of interest from retail shareholders in investment trusts.
Right, so we'll come back to that in a moment, if we may. Let me just take you back to that initial change of management, though, because it so happens that in 2020, which was the year of COVID, there were no fewer than 3, I think, UK equity income trusts of decent size, which changed their manager. They decided to change the manager, and in some cases decided to change the mandate as well. And we know that one of those, for example, is what became Keystone Positive Change, which is now going through a process of basically disappearing eventually. And so that was an interesting choice you had at that point. I'm asking this out of general interest for people, how you go about thinking about this. You can either stick with the same style but pick a different manager who's doing the same thing but in perhaps a more effective way, or you can change the style of the approach, or you can change the mandate completely, as happened with Keystone Positive Change. They went to a very different kind of mandate. So I think Majidi would not describe themselves as being deep value investors in the way that Mark Barnett had been. So what was the thinking about those issues?
Certainly as a board, we thought very carefully about it. We felt that UK income was still an important area to focus on. And we wanted to make sure that the company was built in a core equity savings vehicle for investors, whether large or small. So there was no conscious decision at that stage to change the mandate. And we felt that given the other potential managers we interviewed as part of a formal review process, that Majidi had the best offering to do, given the very long track record James Dupper, who then became our portfolio manager, had as a portfolio manager, having originally started at Mercury Asset Management and having an excellent reputation in the UK income market. And we felt it was worth thinking more holistically about total return rather than purely focused on dividend generation. And that's, as you can see from the results, has actually been a very good approach.
Right, so presumably these kind of mandates don't come up that often, and there's a large trust, or still is a large trust with more than £1 billion in assets, a market cap. So you would have had a lot of offers from lots of people. A lot of people come forward, as you say, before you got down to your short list of 5. I'm sure listeners will be interested in the kind of discussions that were had. I mean, was the board immediately unanimous, or did it take a lot of thrashing out? How did that go?
We had a robust conversation about it. That's one thing I really enjoy about the Edinburgh Investment Trust board. So over the years, obviously I've only been involved for the last 5.5 years, but it has got a history, and I've talked to previous chairs and previous board members about it, that it's had a sort of board which is very diverse, and in this case I really mean diversity of thought. So it's not something where the chair will say, and that's certainly not how I see my role as a chair, I won't just say, okay, this is what we do and you better agree with me. But the then chair, Glenn Soares, also took a view that it was important to involve everybody in the decision and have a proper debate about it. And that's what we had. So you could argue, I can obviously not tell you who else was in the running at the point, but generally there were some more sort of perhaps obvious names, bigger names one might recognise. And having thought about the pros and cons of that, we felt that Majidi had the best offering overall, given, as I said, the experience, giving James Dupper's focus on UK income and given his track record. And so it was definitely not something which was decided in a second or even in a day, a week or something, but it took a number of conversations about it, and it wasn't an easy decision, and sort of Bank of England speaker would probably be finely balanced. We thought about it very carefully, and we wanted obviously to ensure that we would achieve the best outcome for shareholders.
How important in that consideration was the discussion about the fees?
Oh, clearly that was one factor. And as you would have seen also more recently, we've managed to renegotiate the fees, which has been very positive. So it wasn't the most important consideration at the time, although we thought that was something which was worth keeping in mind. Again, obviously, making sure there's good value for money for shareholders.
Now, I can't remember the exact chronology because it was some time ago, but by good fortune, I suppose, from the point of view of the new managers, the Majidi team, and perhaps from the board also, we did have that big COVID market sell-off. So when the new managers took over, it was when the market was a significantly lower level than it had been before. And their performance since then, as you pointed out, has been very good. They've outperformed both the index and most of the peer group over that period since then. But they did start from a very handily kind of low point in the market after the COVID sell-off. Did the COVID market sell-off come into your deliberations at all, or had you already decided?
Oh, no, the decision had been taken before. So I think the announcement was, if I remember correctly, just before the end of the year 2019, so pre-COVID. And then for about 3 months, there was a transition manager in place. And then the Majidi team took over at the end of March 2020. So literally just after COVID had hit. So yes, I see your point that at that point, obviously, there'd been a sell-off. Having said that, if you think about all the volatility in the market since COVID, the Ukraine crisis, the Gaza invasion, the Truss Kwarteng mini budget 2 years ago. I mean, there's been plenty going on in the market, as I know we've all felt. So lots to deal with. And One of the strengths of the portfolio is that it's well balanced, with usually between 40 and 50 stocks with sort of different exposure. And obviously that's always a tricky one, how to best to balance and having the right exposure to different markets and different sectors.
So let's fast forward and finish dealing with the management changes. Now, as you say, the management contract has gone effectively to Lion Trust after Mujadi management changes and James Dupper's retirement. So how did that process work its way through? At what point did you realise that he was going to retire and that Mujadi was going to make those changes that allowed Lion Trust to come in and take the mandate? How did that all unfold?
So let me start with your first question first. So inevitably, if a portfolio manager has had a career spanning decades, 3.5 decades, you know that at some point they'll retire. So we were very fortunate to have James for 4 years of our relationship with Mujadi and then Lion Trust. And as I mentioned, with James's track record and with the NAV and share price both strongly ahead of the index over the period he managed the company, that speaks for itself. And then Imran Sattar, who now manages the trust, who firstly became his deputy, was really the natural successor. And again, Imran has a long track record, has been in the market for decades, and the handover took place over a period of months. So I first heard about it over a year ago, and the board was very much involved in the process of appointing Imran as the successor to James. Imran then formally took over the reins in February this year. So the whole process, I'm pleased to say, has been a smooth one. Obviously, in investment trust terms, less than a year is a relatively short period, but we've been very fortunate that Imran and his deputy, Emily Barnard, have had a strong start to that. And in terms of the change from Mujadi to Lion Trust, we were, as a board, made aware of that as early as Mujadi could share details with us. As you'll appreciate, in these kind of situations, there's always some sensitivity because you want to avoid leakage. So this happened in 2022. I have regular meetings with the senior management team at Lion Trust. The CEO, the CFO have recently met the fairly newly appointed chair of Lion Trust, and we have a very open line of communication to them. So all in all, definitely an interesting time, but in terms of succession planning, it's actually worked well.
I guess the point behind my question was, as I know well from my own experience on a board, Lion Trust has been a very successful manager of open-ended funds. They haven't until now had an investment trust in their stable. But was there any issue about whether or not you were going to formally review the whole process again at that stage, just because of this change of ownership, if you like, of the management team?
I mean, as a board of an investment trust, you always have to think about, is the manager delivering what you want them to deliver? And so inevitably you'll always have in the back of your mind, is this best value for shareholders? What we liked about Lion Trust was their broad experience and capabilities. For example, I mentioned briefly marketing. So it gave Mujadi and then ultimately Edinburgh Investment Trust a bigger platform to be able to access, for example, a retail shareholder base. So that was something Lion Trust was very experienced in. And just to give you an example, in the last couple of months, Imran and Emily, so the current portfolio manager and deputy manager, have sort of gone up and down the country with Lion Trust, who've been setting up all kinds of meetings for them with private wealth managers, etc. We recently had a very popular and successful retail event in London. So the sort of marketing machine, if I may call it like that, is inevitably much more powerful in a larger asset management firm. And we felt especially their experience on the retail side actually would be helpful for Edinburgh as a whole.
You're quite right, they are being very prominent in terms of marketing I don't suppose there's many people who read the financial media who haven't seen a Lounge Trust advertisement somewhere. They're very good at that, very persistent at that, and they have good relationships around the country with IFAs and wealth managers and so on, as you say. So that's all good. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's just talk about Edinburgh Investment Trust then today. It's obviously built up this improved track record over the last 4 years or so. But James Dapper has retired, and then there's always a question around whether a change of manager like that will have an impact on how investors see the trust. But you've got a lot of marketing activity going on. Do you think that it's going to take time, though, perhaps, for this to actually feed through into, for example, a better rating for the trust?
Well, it's a good question, and I'm sure many investment trusts, whether it's portfolio managers, chairs or boards, are thinking about this all the time. What will eventually come through? So if you just look at the results, 3-year numbers obviously have been really good compared to the FTSE All Shares, so 11.3 on a NAV basis versus 7.4 for the FTSE All Share. And if you look at now, so the 4.5. So obviously we'll have the 5-year coming up next year at the end of March is 17.1% on a NAV basis and 18.1 on a share price basis versus 12.4 for the FTSE All Share. So that's obviously, in terms of total returns, excellent.
So these are annualised figures. They're not absolute figures, they're annualised figures you're talking about here.
Yes, they're annualised figures. Now, clearly, we'd like to see that reflected in a narrowing of discounts. That's something which all, especially UK sort of investment trusts, have been grappling with. It's a tough nut to crack. I recently did a piece for the AIC, and some of my AIC and other investment trust colleagues have certainly shared that too, that they found discount management one of the more difficult parts of being a board director and chair. So I think that's something the sector obviously deals with. One of your more recent podcasts was with, I think it was the chair of one of the alternative investment trusts. They've had even a bigger issue in terms of the discounts widening. Obviously, private equity has had issues, real estate has had issues. So it's something which has happened to the sector, and the UK, as you know, has been out of favour. And there are all kinds of different things going into that. So we're not on our own, is I think the good news. And there are lots of other UK-focused investment trusts who would like their discounts to be smaller. The good news is it sort of tightened over the summer. As of the end of September, it was 9.7%. We'd certainly like it to be below 10 and go lower, and time will tell. As I said, we've put a lot of effort and resources into marketing, and we would hope that ultimately this will come through, and time will tell.
Right, so as a board, you have authorised some quite significant share buybacks. So in the last financial year, I think it's about 8% of the share capital last year you bought back, which is quite significant. But the discount does seem to remain fairly stubbornly wide, and it's wider than some of your peers in the UK equity income sector. Do you have an explanation for why your discount is a little bit wider than some of the others in the sector?
Yeah, I'm glad you mentioned discounts. I should have talked about this earlier. So just to give some figures here for listeners. So the last financial year, we bought back, with the help of our broker Investec, 8.5% of shares outstanding. So that was the last financial year. And so far this financial year, we've bought back 2%. So we use buyback actively to manage the discount. There are other trusts who've done even more than that. It's a really good question why the discount is even wider. Now, some people might argue that trusts should have higher dividends overall. Purely, if you just look at dividends, might have narrower discounts. That's definitely something we've thought about. As I mentioned earlier, we've decided to look at overall total returns, which we feel for shareholders is the better outcome overall. Now, interesting enough, at our recent retail event, again, obviously retail investors understandably will ask about dividends and are focused on dividends, especially if they hold investment trust as part of their retirement savings. Having said that, if you have a long-term view, and I'm pleased to say 3 generations of my family are invested in Edinburgh Investment Trust, including my 2-year-old grandson, who thankfully didn't come to the retail shareholder event. I would hope that over his life, he'll ultimately, and hopefully further grandchildren, will see returns overall do really well. And you sometimes have to have a long-term view. And if you think back 5 years when Invesco managed the trust, and Imran mentioned that at the retail shareholder event, he could construct a portfolio where dividends would be higher. Having said that, total returns would suffer, and that's exactly what happened under the previous managers. So yes, it was a more dividend-focused portfolio, but that wasn't good for total returns.
Right, so if you look at the correlation between dividend yields and discounts, I mean, there is some, I think, at the moment, but you don't have any regrets about switching to a total return mandate, because ultimately total return should be of interest to shareholders in equity income just as much as the actual annual yield.
Oh, very much so. In fact, I remember as part of my interview process, I was asked the question by one of my board colleagues who at that point knew far more about investment trusts and portfolio management than I did, and I even then distinctly felt that total return was the right way to go. Perhaps that's why I got the job, could be. So definitely I feel it was the right decision to take.
Right, but I guess you can understand why in certain cases, perhaps some private investors who are less sophisticated, they might look at, Merchants has got a 5% yield roughly, and City of London, that old kind of warhorse, has got pretty close to 5% as well, and you're at 3.8%, and without a bit of education, a relatively unsophisticated investor might think that that's not doing such a good job for an equity income investor.
I can definitely see that, Jonathan. I mean, that's very understandable if all you're focused on is what sort of ultimately you get every quarter as your dividend check, so to speak. I agree with you that constant education and just making the point why total return is important is worth doing. That's why we focus on that as both in the recent retail shareholder presentation and meetings, obviously, with IFAs and others. Interesting enough, I had not so long ago lunch with Imran, and he also shared at recent meetings with the IFAs. That was not something that came up, so they totally get it, why total return is important. So I can totally understand why dividends are important for retail shareholders. Having said that, I would hope that long term they'd be very pleased that we are focusing on total return, because in the long term that will provide better results.
Indeed, and your performance over the last few years does demonstrate that. So let me ask another question, though, which is always interests me. One of the other areas where the board is very important is in setting or agreeing the terms of any gearing that investment trusts make. If you're going to use the investment trust structure, you want to use the gearing at the right time and in the right amounts. I think it's fair to say at the moment you have one of the lowest net gearing positions amongst the UK equity income sector. And that's sometimes quite difficult to reconcile with the fact that when you listen to what the manager is saying, he's saying it's a very exciting time for us. The UK equity market is very cheap. The kind of stocks we're buying are very good. They've got strong business models and so on. So it would seem to be a logical question to ask, therefore, if that's the case, then should not the trust perhaps be using more gearing?
Yes, and I'm glad you bring that up. As you may recall, Edinburgh actually decided to refinance the debt of the trust in 2021. In fact, it had a rather expensive £100 million debenture with an annual interest rate of 7.75%, which was due to mature in 2022. So just to give you some background here, we decided in early 21 to put in place a work stream led by Steve Boltman, who chairs the audit committee, to line up the refinancing of that debt. And at the time when we spoke to potential lenders, that was in mid-21, interest rates were comparatively actually very low. So although our debenture wasn't due to mature until September 22, we decided, and I'd like really the whole board to get some credit for this, and Steve in particular, we decided to pre-arrange our new finance arrangements at the then exceptionally low rates. So this resulted in an interest rate coupon of 2.4% on 120 million fixed for 25 years. So I don't think you'll see many investment trusts who manage to get that good financing. Now just think back 2 years. If we'd left it until autumn 22 and had refinanced in the middle of the mini budget debacle, it would have been a major nightmare. So the timing of this deal turned out to be extremely fortunate. It would have been quite different if we'd waited for another year until maturity of the debt. So obviously gearing is one way in which investment trusts can add value, and that's something which as the board we discuss at regular intervals with the investment manager as well. Ultimately, obviously, they run the portfolio and they take a view on how much gearing to use. Clearly, having that very competitive financing in place has been very good for the trust, and I would hope that provides upside also in future.
Just a personal observation would be that, in my experience, perhaps boards are not as aggressive with gearing as they might be in practice. It's obviously a big call to make, and you need the portfolio manager to be on side with it as well, of course. But perhaps it's a criticism one could make of the sector generally that perhaps it doesn't use enough gearing over time. But in terms of Edinburgh Investment Trust, so you're coming up to this 5-year anniversary of the new management, or the new mandate anyway, and how do you think the market looks out there? As I said, you've worked with the Bank of England, you've been around in business for many, many years. We've had an interesting, perhaps wrong word, budget. There's a lot of questions about the outlook for the UK economy, for the cost of borrowing. We don't know what the impact of President Trump's election is going to be, though I think we can guess what it might be. What's your feeling about where we are in the market cycle as you sit watching it as a board chair? What do you feel?
Well, I would certainly hope that there's a lot of upside for UK equities. So as you said, I mean, we've gone through rather turbulent times. It's, I would say, positive that the budget is out of the way, as many investment trust board members and chairs would have seen that there was uncertainty ahead of the budget. We've heard this also from private wealth managers, IFAs, that there were quite a number of people who were obviously concerned about what changes might be in the budget, and ahead of that took certain decisions in selling out of certain type of investments. So I would hope that now having that out of the way, that would give some stability. Also, elections obviously bring uncertainty, whether it was originally the UK election, and then obviously, this has been quite a week already, having the US elections, and then obviously today the Bank of England's interest rate decision. I mean, there's been a lot going on, and so I would hope that there's more stability coming. Now, I'm not going to comment on geopolitics or politics of specific countries, because you never quite know what's next around the corner. Having said that, if you just look at markets took to the outcome of the US election positively, very positively. If you just look at what's been happening in markets across the world, and especially in the US, in the last 24 hours. Now, sometimes markets can be a bit almost sort of separate from what else is going on in the economy. On the other hand, I would hope, looking ahead, that UK equities are a good place to be, and that investments such as Edinburgh Investment Trust will have a very positive future ahead of them.
So I guess my final question has to be about the UK equity income sector. I mean, we have seen an awful lot of consolidation going on across the investment trust universe. And, some surprisingly large deals. So we're thinking of Alliance and Witten, for example, in the global sector. UK equity income has traditionally been one of the stronger areas of the investment trust universe. A lot of trusts have been around for a long time. But one has to say that out of, I think the IOC list has about 19 trusts in this sector, some of them quite small, obviously. But of those, for my last count, we have about 7 which have assets of more than 500 million. You're one of the larger ones, obviously at a billion market cap. Do you think there's going to be more consolidation even in this sector? And if so, would you want to be part of it? And if so, in what way would you want to be part of it?
I mean, clearly, consolidation is one of the themes across investment trust sector. I listened to your recent podcast when you were interviewing the chairs of Alliance and Witten, and that obviously is a very interesting transaction. Obviously, they have a very different approach, a multi-manager approach, so very different to what Edinburgh has done. As you mentioned, Edinburgh is one of the oldest, most established investment trusts with well over $1 billion market cap. That's definitely a positive. As you would have heard, there are some wealth managers who will have a sort of minimum size threshold when they look at investment trusts. So the good news is that Edinburgh has scale and Edinburgh has had excellent returns. So that gives us strength. So, it's always hard to look ahead in terms of what else is going to happen in the market. I wouldn't be entirely surprised if there wasn't more consolidation going on across the sector. Having said that, there's definitely still very much an interest in UK income. So one of the things we did after our AGM in July in Edinburgh, we brought together large institutional investors. And one of the themes around the table was that they really valued Edinburgh being focused on UK income. So we asked the question, and I do that also when I have one-on-one meetings with institutional investors, what their thinking is, what they like about the trust, what they might like to see. And I was actually pleased to hear that they are very focused on Edinburgh being one of the trusts which is actually focused on UK income. Having said that, it's obviously the board's role to be attuned to what's going on in the market and constantly keep an eye on what would be of best value to shareholders.
So I guess another way of perhaps asking that question is to say, with your business experience, how important is it to be differentiated from the rest of the particular sector you're in? And there are some differentiated trusts in the sector. Obviously, something like Finsbury Growth and Income is a very different approach from what you're doing. And similarly, one or two of the others have more distinctive approaches. But there is a chunk which are fairly similar. So is it important to differentiate yourself? And if so, how comfortable are you that you are sufficiently differentiated to stand out, if you like?
I think you always want to be, among the stronger ones. And obviously, in terms of returns, you always want to be in the sort of upper third of the pack rather than the bottom third of the pack. So that would be important to me. Yes, being differentiated is important. I'm pleased you realise that we've had a strong campaign in terms of marketing. So whether you looked at the FT or Private Eye or other press, whether online or in print. So there's been a big campaign. We had recently also a stand at the AIC showcase. I've, as I mentioned, done something with AIC recently. The SID of Edinburgh Investment Trust, Aidan Lisser, who also chairs another trust, has been very focused on that. That's also his expertise, marketing. So he's been working very closely with a manager on this. So I do think it's important that also investors recognise the brand, and we've done also research on that with the help of Lion Trust. So we have very specific KPIs in terms of how brand awareness has changed, and that's actually on a positive trajectory. So I would hope, as I said earlier, that will translate into the discount narrowing and being sort of visible. It's definitely helped. I mean, I've had people say to me, "Oh, you're chairing Edinburgh." Yes, of course I know about it. I've seen what you've been doing in the press, or I've picked it up here. So it's been good to see that people actually recognise the brand.
Yes, and it's an interesting brand, I guess. I mean, in the old days, having a trust that was called Edinburgh would have quite a lot of resonance with people. I'm not sure whether it's still that relevant today, but obviously we can understand why Foreign Colonial now calls itself F&C rather than the dreaded C word, colonial. But I guess if you've been around for 135 years or whatever it is, you have to hope that your name does indeed carry some resonance.
Yes, and it is actually 135 years this year. The Scottish tradition for us is very important. As I mentioned, we hold the AGM in Scotland. At least one of the board directors is of Scottish heritage, which may be based in this case Patrick Edwardson, who chairs the Management Engagement Committee. He's ex-Baillie Gifford. He's based in Scotland. So we take that very seriously. It's important to us, and for us it's a positive heritage.
Okay, so on that note, I think we should put this to a close, but I'd like to thank you very much, Elisabeth, for coming on the podcast and talking so helpfully about your experience and your approach to being the chair of a larger UK investment trust.
Thank you, Jonathan. It's been a pleasure, and I hope listeners will enjoy this, and I hope that you'll be successful to get more chairs, more non-executive directors, all kinds of diversity to come and talk on the trust. So I'm very happy to help you persuading some people to do this.
Well, thank you for that.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.